Welcome back to Investors Point of View. Hello to all our community members, students, and everyone tuning in. Today, we are strapping in for a complete deep dive into the U.S. stock market's monumental year in 2025. And if you just glanced at the indexes, you saw this relentless strength. But if you were looking closer, which is our job today, you saw a year of really sharp contrasts.
That's the perfect way to put it. Massive, concentrated gains on one side.
Right. And then these surprising pockets of volatility on the other. So our mission is pretty simple. We want to pull out the most important nuggets of knowledge from those 12 months. We're going to go past the big index numbers and really try to understand the true performance, who drove it, and critically, the foundational macro factors that actually shaped your returns.
And that phrase you use, sharp contrast, is so essential, especially for our learner audience. The headlines just scream bullishness, right?
Yeah, nonstop.
But the reality was that most of those gains, well, they were earned by holding a very small group of very powerful companies. If you felt like the market was volatile even while the numbers were climbing, we're going to explain why.
Okay, let's do it. Let's start with the concrete scorecard.
Yeah.
We need the raw numbers that define the year.
Yeah.
How did the major U.S. indexes actually finish 2025?
The scorecard was, it was outstanding. It really reflected this sustained investor appetite for U.S. innovation.
So the flagship, the S&P 500.
It finished the year up approximately 16.4%, closing near 6,845.50.
Wow. 16.4% is a spectacular return. You just don't get that without some serious corporate performance behind it.
Exactly. And that strength, it was underscored by a pretty important historical note. 2025 marked the S&P 500's third consecutive year of double-digit returns.
A three-peat, that's rare.
It's very rare. And that kind of performance, it speaks to deeper corporate health and some really robust forward guidance. It's not just market froth.
But the real story, as it so often is, was the NASDAQ composite.
Yeah. Oh, it absolutely outpaced everyone. And that's really the key signal for this entire year's thesis.
Well, what was the number there?
The NASDAQ saw about 20.4% annual growth. That pushed it deep into the mid-23,000s.
Incredible.
And even the more, traditionally diversified Dow Jones Industrial Average, it still managed a climb of roughly 13%, ending the year above 48,000.
And what about small caps? I feel like we ask this every year. Did those smaller, domestically focused businesses finally catch up after lagging the mega caps for so long?
They finally participated in a meaningful way, which was great to see. The Russell 2000 delivered solid gains of around 11.3%.
Okay, so not bad at all.
Not bad at all. And while the headline performance was dictated by tech, that 11% in the Russell shows that the broader economy was, feeling good enough to lift some of those smaller, more cyclical names, too.
Even with that little bit of a dip at the end of the year.
Yeah, even though we saw some modest profit-taking right at the tail end of December, the overall trajectory for the year was just firmly positive across the board.
Okay, so let's unpack this. We've established the NASDAQ gained over 20%. Where did that massive outperformance actually come from? It really felt like 2025 was the year the entire financial world decided to place all its bets on one single concept, AI.
That's precisely right. The NASDAQ's huge outperformance wasn't just about general growth. It reflects this deep concentration in the sectors powering the foundational AI build-out.
So we're talking chip makers.
Chip makers, infrastructure providers, basically, the companies selling the digital shovels and picks for this new gold rush. They were the dominant drivers.
And was this just hype, or was it backed by real numbers?
Well, that's the key. This wasn't just abstract enthusiasm. I think a lot of analysts were skeptical at first, but the gains were rooted in better-than-expected corporate earnings. We saw that AI optimism directly translate into robust profit expansion.
So they were actually delivering.
They were delivering strong quarterly numbers, validating those massive valuations. It was clear that investors were explicitly crowding into this very small list of winners, providing the AI-enabling infrastructure and tools.
That makes sense. If a company is critical to the build-out, its stock price should reflect that.
Yeah.
But what about other sectors? Were industrials or healthcare just completely left in the dust by this AI tidal wave?
They weren't left behind, no, but they certainly weren't setting the pace. We did see broader strength in industrials. They often posted results that were strong enough to sometimes even outpace the broader S&P 500.
What was driving that?
A lot of it was driven by, reshoring trends and domestic manufacturing strength. But sectors like energy and traditional cyclicals, their performance was much more mixed. It was tied directly to fluctuating global commodity prices and inconsistent global demand.
So they were just too volatile to contribute consistently.
Exactly.
Okay, now for the fun part. Let's shift to the aha moments, those individual stocks that just defined the year's sheer momentum. This is often the easiest way for our audience to remember the themes. What names saw returns that were just staggering?
This is really where you see the themes of a cyclical recovery meeting, that intense AI demand. We're talking about percentage gains that are, well, they're usually reserved for deep value turnarounds or pure speculation.
Okay, give us the top one.
Look at Western Digital, a massive player in tech and storage. It saw returns in the range of 260 to 290% for the year.
Almost tripling your money. That's unbelievable for a large established company like that. How did that even happen?
Well, that's the key analytic nugget right there. Companies like Western Digital and Seagate Technology, too, which was up between 210 and 220%, they were beneficiaries of two things at once.
Okay.
First, a deep cyclical rebound. They had really suffered from oversupply before. And second, this sudden explosive demand from data centers needing massive amounts of storage for AI models.
So a perfect storm.
A perfect storm, a massive short squeeze mixed with a fundamental business turnaround, all driven by that infrastructure demand.
That context is so helpful. It wasn't random. Okay, we also saw huge gains in financial tech with Robinhood markets posting around 230%.
Right. And that Robinhood number, that tells us something important. The retail investor was absolutely back in the game. When you see returns like that, high beta, high risk trading activity,
Right.
especially in things like options, was roaring back.
Giving the market that extra layer of momentum.
For sure. And speaking of core infrastructure, Micron technology, crucial for semiconductor memory, was right there with gains between 178 and 225%.
And it wasn't just tech. You had massive moves like Newmont, a major gold producer, up 130 to 180%.
Yeah, and that reflects that other side of the coin we talked about, the massive flight to traditional hedges amid all the global macro uncertainty. So that stock list, it really confirms the core thesis. Infrastructure, recovery plays, and hedges. That was 2025.
Okay, here's where it gets really interesting for me, because we have to talk about the unseen forces. We've hit the winners, but what were the foundational macro drivers influencing the entire market, causing all that internal volatility?
The primary driver, and often the most jarring one, was monetary policy. I mean, investors spent the entire year just trying to predict the Federal Reserve,
As always.
as always. And although inflation was a key concern all year, the interest rate cuts, primarily in the first half, provided these critical relief rallies to the market.
And I remember that volatility. The Fed's communication felt pretty confusing at first, didn't it? It seemed to amplify the rotations.
It was confusing, which is exactly why the market got whipsawed. So when the Fed cuts rates, it has a direct effect on valuations, right? Future corporate profits are worth more today.
Right.
That's why high growth, high valuation stocks, what we call high beta tech plays, they pop first. But then if inflation data came in hot, suddenly the market would worry about more cuts, bond yields would spike, and investors would instantly rotate out of growth and into safer value stocks.
So that's the risk-on, risk-off dynamic you hear about.
That's it, exactly. That constant anxiety created these jarring postures. Risk on is chasing the high growth tech. Risk off is moving into safety, like defensive stocks or...
Yeah. Or that gold stock, Newmont, we just mentioned.
Precisely. It was a constant cycle of enthusiasm followed by fear, all driven by those tiny movements in bond yields.
And we can't ignore the global landscape. Geopolitical factors were also at play, adding a layer of risk that kept people on edge.
Absolutely. The ongoing trade tensions, especially around tariffs and U.S.-China relations, were a constant source of intermittent volatility. It forced a lot of companies to refactor their supply chains.
And what about the global comparison? There were times when international stocks actually outperformed the U.S. Why wasn't it just U.S. domination all year?
That disparity was usually tied to sector composition. International indexes often have heavier exposure to cyclical, stocks manufacturing, materials, energy.
So they were benefiting from regional recoveries in Asia and Europe.
Exactly. And the U.S. market being so heavily growth-focused sometimes lagged when that global industrial cycle was running hot. And this actually brings us to maybe the most crucial point for our audience: market breadth.
Ah, yes. So the indexes were up double digits, but how healthy was the market underneath those big numbers?
Right. You hear S&P up 16%, you assume most stocks are doing great. But the reality was very different.
So what is breadth, for anyone who isn't familiar?
Breadth just measures how widely the participation is spread. And the breadth issue was perhaps the most defining characteristic of 2025. A relatively small number of huge, large-cap growth names, those AI leaders, accounted for a disproportionate share of the total index returns.
So break that down in simple terms. You're saying a few giant companies basically did all the heavy lifting for the entire S&P 500.
That's a perfect way to put it. I mean, if you looked at the equal-weighted S&P 500, where every company counts the same, the returns were noticeably lower. Analysts estimate that if you had ignored the top 10 stocks, your annual return would have been cut in half, maybe even more.
Wow. That's how much work those leaders were doing.
That's the concentration risk. The foundation of the rally was solid, with legitimate earnings in many sectors. But the spectacular index elevation was powered by a very narrow, top-heavy group.
Okay, let's quickly touch on alternative assets to round out the picture. What was the story in commodities and crypto?
Precious metals had a very strong year. Gold and silver reached new highs, which is just a classic signal of macro uncertainty.
People looking for a hedge.
Exactly. And copper also had a strong year, but for a different reason. It was tied to global infrastructure and the whole energy transition, narrative, EVs, power grids, and so on.
And crypto. Did it mirror the stock market's resilience?
It definitely experienced significant swings. It was volatile. Bitcoin, for example, traded in wide ranges, but it did end the year lower than the peak levels it had seen in the spring. So lots of volatility, but not that sustained, relentless upward move we saw in U.S. stocks.
So how would you summarize the overall investor feeling for the year?
I'd call it measured optimism. Bullish on the tech progress for sure, but balanced with this deep caution around high valuations and global competition.
So what does this all mean for the future? As we look ahead to 2026, what's the consensus and what should we be watching?
Well, heading into 2026, the general outlook is still optimistic for equity returns, but analysts widely expect them to be more moderate.
So no more 20% years for the NASDAQ.
Probably not. The biggest hope is for interest rate stability. That would hopefully allow for and encourage more diversified sector leadership.
Which would definitely help with that concentration risk we talked so much about.
Yeah.
What are the big risks that could spoil the party?
They're really the same ones that caused the volatility in 2025, just amplified. Persistently high valuations in those few leaders, macroeconomic unpredictability, especially around inflation, and of course the potential for new global policy shifts.
So 2025 was a truly remarkable year for U.S. stocks. It was anchored by real innovation and strong corporate earnings. But the central takeaway is that it was structurally top-heavy. It really reinforced the appeal of U.S. equities. But I guess moving into 2026 requires that measured optimism and a real focus on diversification. So here's our final provocative thought for you to chew on. Given the heavy reliance on just a few large tech stocks for 2025's spectacular index gains, do you believe the market leadership will finally broaden out and diversify in 2026? Or will the relentless AI concentration continue to drive the biggest returns for another year? Write your opinions in the comments section below. Thanks for being here. For more financial points of view, you are more than welcome to subscribe to our channel and give it a thumbs up. See you on the next one.